And the U.S. Federal Reserve's benchmark interest rate. His remarks at the Council on Foreign Relations are about an hour.
Okay, I think we can get started. My name is Sebastian Malaby. I direct the Center for Geoeconomic Studies here at the Council on Foreign Relations. Thanks to all of you for coming and for finding us, even though this is not our usual venue. This is the latest in our series of meetings on global economic trends. I'm delighted we have George Soros to talk to us. Before we get going, I should just remind you that please turn off those cell phones, Blackberries, and things that go bleep. This meeting, unlike some council meetings, will be on the record. George Soros has been described in many ways. My favorite, I think, is this is the only individual who has his own personal foreign policy. But it's actually not your philanthropy that's at issue today. It's rather the recent turmoil in financial markets. I saw that Secretary Paulson said yesterday that he felt we'd turned some kind of corner in the crisis. When I checked the markets this morning, it wasn't clear that the equity markets agreed. We'll see what George thinks in a moment. But just to get started, I thought I'd ask a question in this way. You've been a student of bubbles for a very long time. What caused this bubble and what caused bubbles generally?
Well, bubbles have two components. A component in reality, a trend that is really happening in the world, and then a misinterpretation, some misconception. And that misconception can initially reinforce both the trend and the misconception itself. So you get these initially self-reinforcing, but eventually self-defeating processes, because eventually the trend accelerates and the misinterpretation is carried to an extreme, and the gap between reality and the perception becomes so wide that it becomes unsustainable. And then the process goes on. Eventually, you reach a reversal point. Now, the most common misconception, and actually the most common bubble, is in real estate. And the misconception is that the value of the real estate or the house is not affected by the willingness of the banks to provide credit, whereas in fact it is affected. And banks sometimes ignore it. And it's amazing, but it keeps on recurring. So that's the most common, and that's an important element in what is going on, because it's really the bursting of the housing boom that is at the heart of the current financial crisis.
So the banks feel they can lend a lot because the real estate is worth a lot, but the real estate is worth a lot because the banks have lent a lot.
That's right. And so you had, in this case, you had interest rates too low, too long, that encouraged lending, that led to an acceleration in housing prices, and that led to relaxation of lending standards, reinforcing each other. And it's really been, from 2001 to 2006, and then the reversal.
And this point you're making is of more than incidental interest in terms of the sort of intellectual consensus around how financial markets work. I mean, if I'm right, it seems as though one of the central assumptions in modern financial economics has been that investors are rational. They can objectively try to perceive what assets are worth. And what you're saying is that there's always a misperception, and this objective evaluation of asset prices is impossible.
Yes. And in this case, you have this housing boom, which is sort of the trigger for the larger boom, which is, I call it the super boom, which has been going on for at least 25 years, where the real trend is credit expansion. That's what happened in reality. Credit has been growing significantly faster than the GNP, and has been the motor that kept the GNP growing. And the misconception is what I call market fundamentalism, that markets tend towards equilibrium, that deviations from equilibrium are random, and that markets correct their own excesses. And that market fundamentalism became the dominant creed, I think, with President Reagan in 1980. With Margaret Thatcher came to power at the same time. And that actually was the basis of the current phase of globalization. So you've had globalization, liberalization of markets. And then, because markets don't tend towards equilibrium, and they actually go to excesses, you've had a series of crises. But each time the authorities intervened and applied, they bailed out the failing institution and did whatever was necessary to keep the system going. And that reinforced both the credit expansion, because that's how they got the economy going again, is by finding a new way of fostering credit expansion, and the misconception that markets can be left alone because they'll take care of themselves. But of course they don't. It's always the authorities that come in and save the situation.
And so if we look back over the last sort of 3 or so decades of financial history, there was, of course, the stability afforded by the gold standard up till 1971. Then there was a kind of interregnum of inflation, stagflation, and booming commodity prices, perhaps a bit familiar to people in the audience now. And then you're saying that in the Reagan era, there began this period of stability around sort of faith in the dollar, faith in the American system, which made people willing to lend in dollars more and more. So in fact, what you're talking about also is the status of the dollar as a reserve currency, and whether that may now be questioned.
This phase has been based on the dollar as the reserve currency, and with globalization of financial markets, actually, and the Reagan policy at the time of fiscal stimulus, rearmament actually was a big thing, and relatively high interest rates attracted the savings of the world to the center. And that's when we started developing a chronic current account deficit, which has been growing pretty steadily ever since and reached over 6% of the GNP at its peak. So we have effectively, the American consumer became the motor of the world economy, and we were absorbing the savings of the world to finance that overconsumption. And that could have continued indefinitely, because there were countries that were very happy to produce more than they consumed and to accumulate reserves, to build up their wealth. First there was China, then Japan, the Asian tigers, China, and so on. So you had willing borrower, the United States, willing lenders. So a chronic current account deficit was actually a kind of equilibrium. It could have continued indefinitely. And except that with the housing bubble, it's the household sector that became overextended, because they saw the appreciation of houses as a form of saving. So the savings rate actually fell into negative territory, because the houses provided the wealth accumulation, and actually people started withdrawing equity from their mortgages. And mortgage equity withdrawal at its peak was even higher. It was about $850 billion, I think, or $900 billion in 2006. Was even higher than the current account deficit. And it's the housing bubble that is now also unwinding. The this current account deficit.
So there are two halves, in other words, two sides to this long super bubble. On the one hand, the willingness of foreigners to provide loans to the United States. On the other hand, the appetite of the United States to borrow.
Yes,
And
there's a third element, which is the over-leveraging of the financial institutions and the use of various newly invented financial instruments that were not regulated and were used and abused. And these were connected also with the mortgage market, because mortgages were then packaged, repackaged, sliced up, and again repackaged and sold to investors. Banks, instead of keeping loans on their balance sheets, repackage them and securitize them. So securitization and the various synthetic instruments are the third factor. So these three elements come together to give you this super bubble.
And so do you view financial innovation as more of a negative for the economy than a positive?
No, I think but it's not an unmitigated benefit, as, let's say, you could say that many technological innovations, although not all technological innovations are unmitigated benefit either.
Most of them are ambivalent, right?
But we tend to think of it that way. It's not unmitigated because many of these instruments are developed to avoid regulation. So, for instance, if you have loans, then you need to keep, let's say, 10% equity in the loans. But if you just slice up the loan and you take only the risk, you can take risk and have it on and have this credit default swaps. There you only need maybe 1.5% margin. So you can leverage up a lot more.
And is there a way, do you think, for government more effectively to be able to extract the benefits of financial innovation and preserve those whilst mitigating the risks?
Yeah, I think it's basically very healthy to have this innovation, but you mustn't abandon regulation. And that's where market fundamentalism, which believe that you best leave it to the market, you see, that was the excess that led us to the current. It's really the failure of regulation.
I want to probe a little bit more about the super bubble, because if you look in the data about the ratio of American debt to GDP, there's no dispute what's happened in the past. In other words, debt to GDP inched up very slowly between 1950 and 1980. There's a nice graph of this in your new book. And then from 1980, it explodes as a ratio.
A typical parabolic curve.
Exactly. So we know what's happened. The question is, what's going to happen in the future? And you've written in the